This idea of yield curve control, capping rates at a certain level, which I'm certain is coming. It's kind of like the last tool in the toolbox. If the market still overwhelms them and runs past them, what's left?
Physical silver and gold in your hands, personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com. Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update, and back with us today is our friend Craig Hemke from TF Metals Report. Craig, thank you so much for joining us today.
Always nice to see you, Elijah.
Definitely. Great to see you. And the first topic I'd like to discuss is the FOMC meeting. The Fed is meeting and, they're talking about interest rates and all of that. What do you expect to hear from them this week?
Well, I know what I expect to hear from them eventually. It's just a function of whether we'll hear it this week. There was a lot of talk up to even just 2 weeks ago that with the way interest rates have moved on the long end, even just this year, just since the calendar flipped, that maybe the Fed would start taking some steps at this FOMC meeting to try to control that, because they just simply can't afford rates past a certain level for a number of reasons, which we can discuss. But then Chairman Powell did this Q&A thing online with the Wall Street Journal about 10 or 12 days ago, where he was like a really bad bit of like a really bad politician, just kind of dancing around every question and not really giving answers and avoiding all specifics. And he didn't want to give anybody anything. So that left me with the impression maybe, we're going to go through tomorrow's meeting with nothing. And the reason why I'm feeling more strongly about that is that in the time since, it's become clear to me that this idea of yield curve control, capping rates at a certain level, which I'm certain is coming, but I've kind of crystallized my ideas around this, is it's kind of like the last tool in the toolbox. You hear Powell talk about that all the time. He's like, well, we have multiple tools in our toolbox for monetary policy and blah, 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 blah. But this idea of capping rates, yield curve control, is really the final major tool. And what I mean by that is when the time comes, should they actually, rather than just jawboning or saying, we stand at the ready to, buy more bonds out at this part of the yield curve, when the time comes, they actually have to say, we will not allow, say, the yield on the 10-year note to go past 2%, and that the Fed will act aggressively to buy Treasury bonds anytime we get within 5 basis points of that to drive yields back down. That's the final tool, because if the market still overwhelms them and runs past them, what's left? We had a little hint of that last, 10 days ago or so. Bank of Australia, Bank of Japan already have those kind of policies in place, and those caps were broken. And they had to move aggressively to get yields back down under those levels. Because if it gotten away from, what are they going to do? You almost forced into a position where you just nationalize the whole Treasury market, because you can't afford. You just become the buyer and the seller. The Fed just becomes the buyer and the seller, because they can't afford to have other actors in there moving against them, acting against them. And so it is the final two. So anyway, long story short, I think that makes them maybe more reticent to actually unveil this policy. I think the chances are maybe tomorrow we won't get anything other than just the status quo. But that doesn't mean that the status quo is going to go on forever.
So essentially what you're saying is this is kind of the last thing the Fed can do to try to save the economy, essentially. So if this doesn't work, where does that leave us?
Right. I'm not sure save the economy is right as much as it is save the markets or save the system as it is. Because again, think of the scenario where, the Fed is already the major buyer of treasuries. They provide the funds, and then the primary dealers go and buy them, and then they hold them as reserves at the Federal Reserve and so they are funding and monetizing the majority of the debt issuance as it is. And so when the time comes that all of a sudden they can't cap yields at a certain rate anymore because for whatever reason, inflation has taken off. There's no demand for treasuries, or maybe people see the U.S. not so much as a credit risk, but or a default risk, but as you're guaranteeing me losses on my treasuries, adjusted for inflation. So there's just no demand anymore. There's actually selling pressure, and the Fed can't buy enough bonds themselves to counterweight that, to keep yields below a certain level. And so if they've said, we're not going to let it go past 2%, and all of a sudden we're at 2.5 or 3, they failed. And so then what do? And again, I don't know. I'm not saying I have the answer, but in the end, it's almost like that we get into that modern monetary theory stuff, where the Fed just simply monetizes all of the debt, and they say, well, that's just fine because the Fed owns it, and they're working with the Treasury Department, all that. That's kind of what modern monetary theory says, is as long as you own all that debt internally, it's not that big of a deal. Well, we'd be headed firmly down there. Not that we're already not headed down that road, but that's kind of where it goes. So if and when, I should say, when they go down this direction, because inflation is coming, we know that, and the Fed is doing everything they can to prompt it, but they can't let yield on treasuries longer term move up with the inflation rate the way it always has in the past. They're going to cap yields at some point. So as they go in that direction, it'll come in stages. The first thing they'll do is maybe what we'll get a hint of tomorrow. They'll say, okay, we're still buying $80 billion a month in treasuries, but instead of buying all this stuff down here 5 years or less or 2 years or less, we're going to start buying more 7 years and 10 years and 20 years and spreading it out farther. As a way of saying, hey, look, we're buying more of these longer bonds. That might push the rate down. If that's not effective in keeping rates down, then maybe they'll start to say, well, we're at least thinking about putting this yield curve control. And if that's not enough to keep entities from selling bonds at a certain rate because they know the Fed's just going to drive the rates back down, that might be enough. There's just kind of a de facto, kind of jawboning of it. But if that fails, then they actually have to do it. And then what happens if that fails? So that's the road they'll take. It'll come in stages. We might get that first step tomorrow, but what I'm worried about is that because they're so reluctant to start this final process, they may hold off until, not that it's too late, but hold off until the effectiveness of it may be limited. You know what I mean? You wait and you wait and you wait and you wait and you think, okay, now finally you act, and it's too late at that point, I guess is what I'm trying to say. So we'll see.
How do you see this impacting the precious metal markets? Because we see this, the main argument for why we've seen this sell-off in gold and silver is that interest rates have been rising, right? So if the Fed says, no, we're going to cap interest rates and not let them go above this level, that should be very bullish for gold and silver.
Absolutely. Absolutely. And over time, and I'm talking decades, the primary greatest correlation with gold prices is the level of inflation-adjusted interest rates. And there's a fundamental reason for that, because the primary competition for gold as an investment is that 10-year Treasury note. That's the benchmark foundational investment really for all the global central banks and pension funds and insurance companies and the rest. Well, if you're getting a positive inflation-adjusted return, that's not a real conducive environment to make an argument for gold. And the most recent period that we saw that was about 2013 to 2018. Treasuries were between 2 and 3%. Inflation's down 1.5 to 2. The difference is positive 1%, and gold goes sideways for 5 or 6 years. When gold really took off last year was when inflation still hung there at 1.5%. But that yield on the 10-year Treasury went all the way down to 50 or 60 basis points. So you're at 1.6% inflation, 0.6% Treasury yield. That's negative 1%. Okay, so even old gold doesn't pay a dividend, just sits there and collecting dust. That beats the pants off a negative 1%, doesn't it? So that makes gold very attractive. And when we got to that -1%, it was when gold was at 2,100. In the time since, now the 10-year Treasuries come all the way up to 1.6 and is equal to the inflation rate. Those real rates are now at zero, and gold's fallen back $400. Okay, but I'm right about all this, and history suggests the Fed has done this yield curve control stuff before, back in the 40s and 50s after World War II, when debt to GDP got to this same kind of levels. When they do this again, and those, say they lock in the 10-year Treasury at just a round number sake, 2%. They're not going to let it go past 2. But we go to 3% inflation. Well, now we're -1 again. Okay, that would argue, well, why wouldn't gold be $2,100 again? But if it goes to 4, well, now we're -2% on the Treasury. So then where are we going? Then you get everybody piling in. And the last time we had significantly negative real interest rates was in the late 1970s. And it was in that period when they went to -3, -4, -5, and gold went from $100 to $900 in about 3 years. So that's how these pieces fit together. That's why the Fed is important. That's why real interest rates are important. And that's all part of how, at least I can come up with kind of a more longer term forecast, rather than just kind of picking at it, trying to catch swings, and that kind of thing.
Now, looking forward in the precious metal markets, what is your analysis saying for maybe the next 3 to 6 months? Because I'm hearing from multiple people that it looks like, at least if we look at where silver is right now, if we get like a break above 28, 29, 30, we could, skyrocket possibly to, the all-time high of 50 pretty fast. And I'm hearing that from different sources. So what is your perspective on that? Do you see possible just skyrocketing silver price soon?
It's possible. And let's start with silver. Silver is, mainly thought of as a commodity. I mean, you and I think of it as a monetary metal, but I mean, we are in the vast minority on that deal, right? Most everybody else thinks of it as an industrial metal, a commodity like copper. And commodities in general are breaking out of 7, 8, 9-year downtrends. Copper is the highest levels recently that we've seen in 8 or 9 years. Crude oil's highest level been a year and a half. Lumber's all-time highs, things like that. So in a general commodity bull market, that's obviously going to be very beneficial for silver in its own right. The silver squeeze movement is doing a bang-up job of soaking up all of the silver for investment demand. The world mines 850 to 900 million ounces of silver a year, and industrially consumes 550 to 600 million. So that leaves only about 300 million ounces for investment demand. I mean, we're chewing up through that really, really fast. So you get, not necessarily shortages, but definitely supply imbalances. So that factors into it. You got the falling dollar, that factors into it. And then when you look at the chart, like you said, the first step is we've yet to have a weekly close above 28. All that messing around last summer, all the fun back in February, traded above 28 intra-week, but we've never closed above 28 on a Friday. That's the first thing to watch. Then we trade above the highs from both last August and back on February the 1st. We start closing on a week up above there, somewhere north of maybe 30, 50. And then, you can sure see where it's pretty close, pretty quick to 34, 38. That was my forecast for this year, actually. It was up near around 38. I thought that made sense, but I mean, silver, man, is a crazy deal. I mean, it could certainly go well past there, depending on a range of other conditions. And then in gold, that's, like I said, there's a reason why we've gone even just this year from 1900 down to wherever we are now, 1730. That's because that 10-year Treasury note began the year under 1%. Now it's 1.6. So if rates continue, if that cap that the Fed's uncomfortable with letting rates go any higher is, say, 2%, if we still go from 1.6 to 2, gold's going to remain under pressure, right? But in time, that will change, and inflation will surge past that yield. They'll cap that yield. We'll start going negative again. That'll open the floodgates for more buying, not only of real gold, but all of the pretend gold that's out there, the futures contracts, the ETFs, all the other jazz. and it'll all turn, and then you'll get a recognized breakout, and then we'll start back into the 19s again, and people get excited. Then we'll get higher than we were in November and January. People get more excited. Then all of a sudden we'll be trading with a 2 again. You know how that works. That's coming. It's really hard to say. I mean, it might start tomorrow if the Fed surprises everybody, and that low could be from last week. But until then, we're just kind of in this downward consolidation until the Fed finally makes that policy shift. And so we'll keep waiting for it. Definitely.
So what I'm hearing is the short term, you're more short term bullish on silver than gold right now.
Yeah. And Elijah, you can see this in the miners too, which often kind of reflects that trend. If you pull up a chart of, say, the GDX or the GDXJ, the gold miner ETFs, and you look at it and you go, that doesn't look so good. And then you pull up a chart of, say, like the SILJ, which is a silver miner ETF. It looks completely different. Not kind of range bound, but slowly making some higher lows. And so even that chart of those silver miners looks a lot better than gold. And so that, again, is consistent with maybe silver, just because it's, again, deemed a commodity on top of all the other stuff that's going on. Makes silver more attractive in the short term. Maybe people look at that gold-silver ratio. Maybe that gets to a low about the time when all of a sudden gold starts to take off again. I mean, that might be another way to look at it. But yeah, in the short term, until we get a change in Fed policy, silver is maybe going to trade better than gold.
All right. And that's definitely something we'll have to keep a very close eye on and what the Fed decides to do and very soon. But Craig Hemke, we really appreciate your time today. And if people would like to learn more, hear more of these interviews, they can hit the subscribe button and the bell icon so they'll be notified of all the new interviews coming out. And where can people find you online if they're interested in learning more?
Am I pointing on the right side this time, Elijah? I always screw this up. Right there, TF Metals, just tfmetalsreport.com. We are celebrating our 11th year. I was a young guy like you, Elijah, when I started. Now I look like Fred Sanford. I've got all these wrinkles and lines. All these years of watching nothing but the precious metals will do that to you. But it's a fantastic community. And so if you believe in some of the stuff we've been talking about here, that the precious metals are your defense against all of these events that are pending in the debt and the deficit and how they're going to finance it, then you need to surround yourself with some friends that can help you figure that kind of stuff out. How do you allocate your assets and what kind of metal is best, all that kind of, they're all things we talk about at TF Metals Report. So please check us out, just tfmetalsreport.com.
All right, Craig Hemke, once again, thank you so much for your time and God bless.
Thank you. All the best, my friend.
Physical silver and gold in your hands. Personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com.